I'm Sung Lee. This is the Money Manifesto Mastering Your Finances for Wealth Creation video series. Let's begin. Before we dive in, a quick heads up. I'm not a licensed financial advisor, and my goal is to empower you with information, not tell you exactly what to do. Always double check any information you hear, including mine, and make sure it aligns with your personal financial goals and situation. Remember, you're the driver of your financial journey, and these are just helpful tools to put in your toolkit. So, with that out of the way, let's get started on mastering your finances together. Today, the topic of discussion is Growing Money Pearls and Buying and Selling Security Guide in part 1 of the book. These two sections will also be the closing out sections for part 1. The topic is growing money pearls. Think of it as cultivating your own bed of financial pearls, each one representing a valuable investment that grows over time. We will cover essential topics like building an investment philosophy, understanding individual stocks and index funds, and even learn how to open accounts to get started. We will also explore asset allocation and see the difference between investing in an index fund versus an individual stock. Let's establish a solid investment philosophy. This acts as your guiding principle, defining your approach and long-term goals. I will go through and explain each point. Invest in what you know. Do your research and keep it simple. Understanding your investments helps you make informed decisions and manage risk. Past performance is no guarantee of future results. Don't assume a company's past success predicts future growth. Research current trends and company health. If cash flow management is the issue, making more money will not help. Focus on creating a budget and managing spending before increasing investment amounts. Investment is not the same as betting on the market like gambling. Investing involves research and strategy, not blind luck. Money can be lost quickly, but building wealth takes time. Be patient and focus on long-term growth, not short-term gains. High risk does not always equal high rewards. Consider your risk tolerance. High risk investments can lead to significant losses. Invest regularly. Consistency matters. Regular contributions, even small amounts, can add up significantly over time. Time in the market beats timing the market. Staying invested for the long term generally outperforms trying to predict market fluctuations. Embrace the efficient market philosophy. Buy and hold the market. The market reflects all available information, making it difficult to consistently outperform it with individual stock picking. Invest in broad market funds for long-term growth. Invest your money in different stock funds, such as growth, value, or emerging stock funds, to diversify your portfolio. Different sector funds, not individual stocks. Diversification spreads risk across different asset classes, minimizing losses from any single investment. Focus on sector funds instead of individual stocks to simplify management. Everybody has the intelligence to succeed in the stock market, but not everyone has the stomach. You should stay away from stocks and stock mutual funds if you tend to panic and sell during market downturns. Investing requires a long-term perspective. Don't let emotional reactions dictate your investment decisions. Invest in stock index funds or mutual funds if you are comfortable with stocks but lack the time or desire to do your research. Index funds and mutual funds offer a diversified and lower maintenance way to invest in the stock market. Remember, investor behavior matters more than the market's behavior for long-term investments. Discipline and a well-defined investment strategy are key to success. To create your portfolio, determine your personal risk tolerance, ranging from conservative to aggressive investment. Your risk tolerance influences the types of investments you choose. Consider your age, financial goals, and comfort level with potential losses. Stay up to date with current tax rules, interest rates, annual investment limits, and remember to read. Knowledge is power. Staying informed about financial regulations and trends helps you make informed investment decisions. Here are some tips for owning individual stocks. Owning shares in a company allows you to potentially benefit from its growth. However, this involves researching specific companies and accepting higher risk compared to some other options. What are some benefits of index funds? These passively managed funds track a specific market index, offering broad diversification and potentially lower fees compared to actively managed funds. Index funds typically have lower expense ratios compared to actively managed funds. Index funds provide built-in diversification, thus reducing risks. Historically, index funds have matched or outperformed actively managed funds over extended periods. Index fund investing is relatively straightforward. You can almost invest, set it, and forget it. I said almost, meaning you would still want to check up on your index funds or your investment once to twice a year. Index funds often generate lower capital gains distributions, resulting in potentially lower tax bills. If you own individual stocks, you may get dividends that are distributed quarterly, and you must pay ordinary income tax on the distributed dividends during tax time. Index funds are widely available through brokerage accounts and retirement plans. While actively managed funds aim to outperform the market through stock picking, index funds simply track the market. Studies have shown that index funds often outperform actively managed funds over the long term. Actively managed funds do not outperform index funds, and they have higher fees, which is to pay the manager who manages the active funds. I'm not a big fan of it. Index funds are not a guaranteed investment, and their performance can fluctuate. However, they offer a compelling investment option for those seeking a low-cost, diversified approach to building wealth. We have discussed the benefits of Treasury securities as a safe and reliable investment option. Now let's explore how to access this market directly through a Treasury Direct account. Treasury Direct is a government-run website that allows you to purchase, hold, and manage Treasury securities electronically. It's a free and secure platform to invest in U.S. Treasury bills, notes, bonds, and saving bonds. Steps to open Treasury Direct account. First, visit the Treasury Direct website at www.treasurydirect.gov to initiate the account opening process. Select the type of account you want to open, whether it's an individual, entity, or custodial account. Then enter your personal information. Last, you provide your checking or savings account information to fund your Treasury Direct account. Complete the security verification process to confirm your identity. Carefully review the information you have provided and submit to your application. Another type of account is a brokerage account. A brokerage account is a financial account that allows you to invest in various securities such as stocks, bonds, mutual funds, and ETFs. It's your gateway to the investment market. Choose a brokerage firm, research and select a brokerage firm that aligns with your investment goals, fees, and level of experience. Many online brokerages offer a variety of account types and investment options. Prepare your personal information, and you may also need financial information like income and net worth. Complete the application by visiting the brokerage firm's website and complete the online application form. Be sure to provide accurate and up-to-date information. Once your account is approved, you can fund it by transferring money from your bank account or linking a debit card or credit card. Once your account is funded, you can begin exploring investment options and executing trades. Understanding the different types of brokerage accounts available, such as traditional IRA, Roth IRA, rollover IRA, or individual brokerage account. Compare fees charged by different brokerages, including trading commissions, account maintenance fees, and other charges. Fidelity and Charles Schwab are my two favorites online brokerages because they have low or zero fees. All right, let's discuss asset allocation. There are online tools to help you create an asset allocation. There are asset allocation calculators that can help you determine an asset allocation based on your individual circumstances. You can Google asset allocation calculator and you will find many results with asset allocation calculator. Use online tools. Many financial institutions offer free questionnaires to help gauge your risk tolerance. Charles Schwab's questionnaire is open to everyone and categorizes you into one of 5 profiles, from conservative to aggressive. Vanguard's tool also has a stock bond cash mixed based on your responses. Also, robo-advisors platforms like Schwab, Intelligent Portfolios, E-Trade's Core Portfolios, and Fidelity Go offer model portfolios based on your age, time horizon, and risk tolerance. Remember, your mood and market conditions can influence your answers, so try to be as objective as possible. These tools provide a starting point for understanding your risk tolerance, helping you build a portfolio that aligns with your financial goals and comfort level. Let's talk about how to combine them effectively. This is where asset allocation comes into play. So what is asset allocation? It's simply the way you divide your investment money among different assets like stocks, bonds, and cash. The goal is to balance risk and reward based on your personal goals and risk tolerance. Asset allocation is a powerful tool that can help you reduce overall portfolio risk, smooth out market fluctuations, and keep your emotions in check during market turbulence. Diversification is one of the benefits of asset allocation. Spreading your investments across different asset classes helps reduce risk. When one asset class performs poorly, others may offset those losses. Risk, man- Risk management. By carefully allocating your assets, you can tailor your portfolio to your risk tolerance. A more conservative investor might allocate a larger portion to bonds, while a more aggressive investor may lean towards stocks. Improved returns. While there's no guaranteed formula for maximizing returns, asset allocation can help optimize your portfolio's performance over time. This asset allocation example table is from Keeplinger. We will discuss the fundamental components of an investment portfolio: stocks, bonds, and cash. Let's start with stocks. These offer the highest potential returns over time, but come with greater volatility. In the past 2 decades, stocks have averaged annual returns of about 10%. For broad exposure, consider index funds like the Vanguard Total Stock Market (ETF) for US stocks and the Vanguard Total International Stock Market for global markets. Next are bonds, which typically provide stability to a portfolio. While their returns are generally lower than stocks, averaging 3.2% annually over the last 20 years, they usually experience less price fluctuation. For a core bond holding, you might look at the Bear Aggregate Bond Fund or the iShares Core US Aggregate Bond ETF. Finally, there's cash. In the current high-interest environment, cash investments can yield around 4% or more. Options include high-yield savings accounts, short-term treasury bills, or money market funds such as the Vanguard Federal Money Market Fund. The appropriate mix of these elements in your portfolio depends on your personal risk tolerance and investment timeframe. Typically, as you approach retirement, you might increase your allocation to bonds and cash for greater stability. The model portfolios shown on the table can serve as useful starting points, ranging from conservative to aggressive based on risk levels and time horizons. Constructing a portfolio is about finding the right balance for your individual financial goals. Rebalancing your portfolio. Market fluctuations can cause your asset allocation to drift over time. Rebalancing is the process of adjusting your portfolio to restore your original asset allocation. This involves selling some of the assets that have grown and buying those that have declined. Remember, asset allocation is a long-term strategy. It's essential to regularly review your portfolio and rebalance as needed to maintain your desired risk level and investment goals. The following 3 sections are the sections I typically review from the fact sheet or prospectus when selecting funds in my 401k account or brokerage account. Investment strategies, fees and expenses, and past total returns. Principal investment strategies. The way a fund invests your money is crucial to its performance. Here are some common strategies that you may find under principal investment strategies. Index funds. These funds track a specific market index, providing broad market exposure at low costs. Bond funds. These funds invest in various bonds, offering income and potentially capital appreciation. Target date funds. These funds automatically adjust their asset allocation over time to become more conservative as the target date approaches. These funds automatically adjust their asset allocation over time. This means you don't have to worry about manually rebalancing your portfolio. While target date funds adjust their allocation over time, it's essential to consider your personal risk tolerance. I like to use Google to find index funds. You can search for best total stock market index funds or best index funds, or if you want to be more specific and want to invest in a specific sector, such as US total market, US market, or US total market, or growth, value, or technology sector, just to name a few, you can Google search the put in Google search best technology index funds or best US total market index funds, and compare the expense ratio, and make sure the expense ratio is under 0.1% or close to 0% as much as possible. Then you can review their past performances. Remember, past performance is no guarantee of future performance. Then select the fund that best fits your preferences. So how do you analyze and select funds? This is an example of what your 401k dashboard may look like. Investments and research is where you should find fund information and fund performance to analyze fund information. Remember the three sections I typically review from the fact sheet, fund information sheet, or prospectus when selecting funds in my 401k account or brokerage account are the investments, strategies, fees and expenses, and past total returns or past performance. This is an example of the fund information section in your dashboard that shows past performance. But remember, past performance does not guarantee future performance. Your 401k portal may not show the exact format, but you should be able to find something similar to show you the fund's past performance. This is the one-page fund information sheet. Sometimes it's called the fact sheet. You will find in your 401k portal. You can read about the investment objectives and strategies for the fund here. This is one of the three things I review when selecting a fund. From this paragraph, you can see the investment seeks to track the performance of the S&P 500 index, which measures the investment return of large capitalization stocks of large US companies. If you look further at the portfolio analysis, you can see that it comprises 99.3% of US stocks. You can see the top 10 holdings or companies this index funds invests in, and the types of sectors in this fund. Under operations, you will find the fees it charges. As you can see, the fees are 0.04%, which is low. We want the fees to be less than 0.1% or close to 0%. These small fees will add up over time when your portfolio grows. Let's visually see what we have learned. We will compare two investment choices, the S&P 500 Index Fund, shown in dark blue, and Disney stock, which is the pink line. Looking at their performance from late 2019 to August 2024. I chose Disney stock for comparison because most people know this company and it was a stock my son selected when he started learning about index funds and individual stocks. In March 2020, when COVID-19 hit, both investments took a significant hit. But what happened next is quite interesting. From March 2020 to January 2022, the market surged impressively. The S&P 500 shot up by 72%. Disney initially did even better but started to lag behind as time went on. Then came 2022, bringing high inflation which led to interest rate hikes. Both investments declined, but Disney fell much harder. From January 2022 to January 2023, the S&P 500 dropped 18%, while Disney plummeted by a whopping 44%. So, what can we learn from this comparison? First, diversification matters. The S&P 500, representing 500 large U.S. companies, weathered the storm better than a single stock, such as Disney. This demonstrates the power of spreading your risk across multiple companies and sectors. Second, higher risk doesn't always mean higher reward. Disney, despite being a well-known and popular company, proved more volatile and ultimately underperformed compared to the broader market index. Third, emotions can lead to poor investment decisions. The panic selling during downturns often results in buying high and selling low, which is the opposite of what successful investors aim to do. Lastly, a long-term perspective is important. Despite short-term fluctuations and periods of decline, the overall market trend has been upward over time. Remember, past performance doesn't guarantee future results. But understanding these principles can help you make more informed investment decisions. Whether you are considering individual stocks or index funds, it is important to consider your risk tolerance, investment goals, and time horizon. At the bottom of the screen is the pathway to the comparison chart if you want to compare different funds or stocks. Here are some key takeaways for today's presentation. Seek simple investment opportunities over complicated ones. The most boring investments are often the best ones. Experts consider market timing, the attempt to predict price movements, a losing game. Experts recommend time in the market, which means consistent investing over the long period of time to mitigate risk. Invest smaller amounts regularly with dollar cost averaging to minimize price risk, regardless of market conditions. Emotions often lead investors astray. Market timing and emotional reactions can cause people to buy high and sell low, undermining investment success. Key principles include investing in what you understand, avoiding market timing, and recognizing that investor behavior influences long-term results more than market behavior. The concept of market efficiency results in properly priced equities. The idea of buying and holding the market through index funds is key to success. High risk does not always lead to high rewards, and it is important to make informed investment choices. Diversify your investments across various sectors and asset classes to reduce risk and gain exposures to profitable areas of the market. Creating an asset allocation plan based on your risk tolerance and investment goals is important for portfolio success. It is advisable to hold a mix of stocks and bonds. Financial calculators are great tools to project investment outcomes. They provide insight into various scenarios and help plan for financial goals. We have explored the key concept of growing money pearl. equipping you with valuable investment knowledge. Remember, investing is a marathon, not a sprint. Start by taking small steps, consistently learn and grow your financial literacy, and don't be afraid to seek professional guidance if needed. I have enjoyed sharing my knowledge with you through this series. However, this will be the last video in this series and the last video I will create. Thank you for your support and for being part of this financial learning journey. I encourage you to continue exploring the world of investing and seeking professional advice when needed. Thank you again.